All right. Happy Monday morning. We got a Monday market update. I'm Matt Gouget, Matt the Mortgage Guy. Unfortunately, my partner in crime, Mr. Nash Paradise, the Loan Wizard, is moving, and we'll talk about that today. People are still moving. People are still buying houses despite consumer sentiment numbers being, I believe, their lowest since June of 2022 is what I had read. So I'm going to go through some numbers, some things we saw last week, what is ahead as far as economic and mortgage news this week. Then I want to talk about what I'm seeing in the market. I think that's valuable for anybody listening, whether you're a loan officer, a real estate agent, a consumer looking to buy, hearing from someone who's talking to consumers and real estate professionals every single day, someone that can give you real-time feedback of what's going on as a whole, I think is a lot better than perhaps, articles written or numbers that don't always tell the full story because as we know, sometimes numbers lag. Sometimes also numbers can't tell context and things of that nature. So let's take a look at the economic news. And I'm going to give you a really simple recap. As we all know, Nash Paradise loves to get into the nitty gritty. He really follows this stuff rather closely. I'm going to give you the cliff notes. And if we want to look at last week, what happened with mortgage rates, they were relatively flat. I think they ended the week slightly better than they started the week. The big things were that CPI inflation numbers came in lower than expected. So that's a good thing for mortgage interest rates. We liked that, and mortgage rates liked that. The only problem is that we still have these ongoing concerns about tariffs, and that tariff uncertainty and the potential impact of tariffs on inflation and the overall economy contributed to upward pressure on rates, which kind of canceled out any positive downward pressure we saw from that lower CPI number. So that's the cliff notes on that. We can look at what's going to be going on this week. And from the chart on your screen, if you're watching this on YouTube, it's a lot less than last week. These red bars indicate the stuff that has a higher impact on mortgage numbers. So it's stuff that we want to keep closer eye on. And it's basically manufacturing PMI and global services PMI data. That stuff comes out Thursday. So we'll watch. Just like last week, we always are going to be glued to what's going on with tariffs. What's the latest talk? How is that impacting mortgage rates? And the news we got this morning as mortgage rates came out that really had a negative impact on mortgage rates is the U.S. was downgraded by Moody's. And the reason for the downgrade is because we hold a lot of debt as a country. 37 trillion. That's a pretty big number. If you haven't ever wrote out, what 37 trillion looks like, just take out a piece of scratch paper, 37 comma, and then follow it by 12 zeros. Most of us, it's hard to comprehend how large of a number that is, right? You take 1,000 millions and you get yourself a billy. There's a bunch of fun exercises you can do. So play with Chat GPT on this one and say, if I was handed a dollar bill every second, how long would it take to hand me $1 billion? And then do that same thing for $1 trillion if you want a treat. I actually don't know those numbers, but I know it's crazy. Maybe I'll come next week with those numbers prepared. How many days or years is it if you were counting to 1 billion and you counted one number every second, and then what would that be for 1 billion? So enough on that tangent. I think let's look at the Fed funds rate. We were all surprised last week at how this had shifted dramatically, and I'll run through this relatively quickly. The June meeting, there's about a 91% shot that we stand pat, no cut. And, if you read what the Fed has been saying and kind of their mood, they're in a wait and see type of holding pattern when it comes to interest rates. So the expectation now, which continues to shift, we were expecting some mid-year cuts, and we're expecting like 3 cuts by the end of the year. As recently as 30 days ago, that's shifted dramatically. And now it's going to be September before most people expect any rate cuts from the Fed at all. And then number 2 is expected in December. So 2 rate cuts for all of 2025. That's the current expectation. As you can see by this chart, it's a 92% shot as far as what we're forecasting for 2 rate cuts to get us to 375 to 400 for the Fed funds rate. And then if you really, want to look ahead, which I think is probably pretty insignificant, knowing all the stuff's going to change between now and the end of 2026. It looks like 2026, a total of 2 cuts is what the probability, or at least the expectations and forecasting model tells us about rate cuts then. So slow and steady, wait and see. A lot of uncertainty around a lot of different things, mainly the economy, mainly tariffs and how they affect the economy. And now this new concern that has kind of arose, the U.S. debt. I think there was a number that I saw this morning, public debt to our GDP. That number is something like 123%. So concerning for sure. And all that stuff is going to have an effect on mortgage interest rates. All right, let's pull up mortgage rates since this is what everybody wants to know. Quick reminder for folks, because I have this conversation quite often. People say, hey, I've got an 800 credit score. I should have a much better rate than a 6.99. Why am I looking at 6.9 and it costs me a half a point to get there? Keep in mind, this average mortgage rates, if I cross-reference this with what I see, and as a broker, I can price 15 different lenders all at once. This 6.92 or 6.94, whatever it's currently at, is probably a rate that if you've got great credit and you're putting 20% down, maybe even 25% down, this is still going to cost you a half a point to a point. The average consumer is not going out and getting a no-cost rate. If they were, and especially if they've maybe got a 710 credit score and they're putting, I don't know, 10% down, they're probably looking at something with a 7 handle. And these sub 7s, 6.875, 6.99, is something that might cost a little bit, points, origination, whatever the lender you're talking to calls it. So keep that in mind. A lot of people are setting false expectations with themselves, and then they're disappointed. Like, oh my gosh, I thought, if the national average was 6.92, I was going to get a 6.25 because I've got an 800 credit score. Not necessarily how it works. Any of these averages is going to, as you would imagine, look at a pretty rosy scenario. If you ever look at an online lender and they'll advertise 6.125, and that's 40% down, paying 3 points or whatever the case may be. So anyhow, most consumers are locking stuff in the high 6s or low 7s. Most consumers don't want to pay a lot of upfront cost, 2 or 3 points. So be aware of that and kind of look for that. If you've got a lender saying, yeah, I got a 6.5% for you, if you're going to pay $13,000 for it and pay 3 points up front, you're going to be in a tough spot if rates come down over the next 12 to 24 months and you're in a great position to refi. You'll still be able to, you just might regret all the money you spent up front. And I get it, locking yourself into a 6.99 or a 7.25 might feel like the payment is something that is not as attractive as that 6.5%. But if you're paying to save $180 a month and you're paying $10,000 up front, it might be 55 or 60 months before you break even. And again, who knows? Maybe you stay in that loan for more than 5 years, but for a lot of people, they're like, I'm watching these rates. I've got a great professional I'm working with who's going to monitor that. And trust me, you've got plenty of systems out there. You've got AI that's going to literally give you a call on my behalf when you're in a position to refinance. Before that even comes, you're probably going to get mailers. You're probably going to get, promises from online companies. So you're not going to miss a refinance opportunity. And so a lot of the clients I'm working with are paying less than a point to get into the rate they're locking at. That's very long-winded, but hopefully helpful for some of you listening, because you don't want to be fooled by a low interest rate. That is kind of a common selling tactic for some of these big call center type lenders, is show them a good rate. They will be so enamored and eyes glossed over that they won't notice the $15,000 we're charging them for that low rate. So that's that. Enough about mortgage interest rates. I'd love to just talk about consumer sentiment for a little bit. Consumer sentiment matters. And while it might vary from state to state, different demographics and, different type of consumers, the overall consumer sentiment down in May, something like the reading in April is 52.2, I think was the number. And consumer sentiment in May, 50.8. So it's down, and it was down. It was the lowest reading since June of 2022. June of 22 was really the start of when mortgage interest rates started to climb out of their historical lows. And we've been so low for so long that it's taken these 3 years for consumers to finally, in my opinion, realize that wasn't normal. Having mortgage interest rates on a 30-year fixed sub 3%, while it was phenomenal and great while it lasted, the only reason we had those rates is because we had a once-in-a-lifetime event that caused enough havoc to our economy that we had to do something drastic. And that something drastic was pull down that Fed funds rate to 0. I got a lot of, notifications, got a lot of calls. Mortgage rates are 0. That was literally what I got in 2020. I think I've got a video on YouTube that reminds people the Fed funds rate does not equal mortgage interest rates. Mortgage interest rates weren't zero, but they were as close as they've ever been. For a lot of people, their 30-year fix got locked in at 2.5, 2.6, 2.875. So the fact that we're now in the sixes, some people, if they have challenged credit, might even be in the sevens. And then if you're buying an investment property or you're doing maybe a bank statement loan, whatever the case may be, you might be getting 30-year fixed rate money in the sevens or eights even. That, for a lot of people, is hard to swallow because the truth is, I'm a numbers guy. And for people who aren't looking at it daily, they don't realize it's a vast difference. You borrow $400,000 at 2.5%, and your monthly payment is really small, right? Like, I don't know the exact number, but let's call it $1,500. Then you add on tax and insurance, and you've got a payment of $2,100. You get into an environment like we're in now at 7%. And why guess when I've got this computer in my hand, the cell phone, man, technology is great. 400,000 at 7%. That principal and interest payment is $2,661. Now, while I'm here, let me put in 275. $1,633. So about $1,000 difference. So, maybe it's the same house, and 275 to 7% now translates to a payment of $3,200 instead of $2,200. That is a 40%-ish increase. That's a lot. And the issue and what's pulling consumer sentiment down, in my humble opinion, as somebody who talks to consumers every single day, is that this housing cost isn't the only thing that's increased. Groceries are more expensive. The homeowner's insurance to insure this house is more expensive. Gas might be more expensive. Your car insurance to own and insure that car is more expensive. Childcare costs are more. Everything is more expensive. And so for consumers who might only see a 4, 5%, 8% increase to their wages, are now seeing 30, 40, 50% increases to life and shelter costs. Whether it's rent, that's up too, or it's a purchase. Everybody needs shelter. Everybody needs a place to stay. Those costs are up quite a bit. And so, as you would expect, consumer sentiment is down. But with all of that being said, I'm still talking to consumers every single day that still understand real estate as a long-term investment is a phenomenal one. I think Professor Scott Galloway, who's well known in a lot of financial circles, there's a little clip from him, and he was talking about investments as a whole, or the interviewer talking to him about it, and he said, if it was me, I would just buy investment real estate. It's an asset you can feel and touch, and over time, it's just proven to be about as dependable as anything else. And of course, I'm paraphrasing, but you continue to hear people, despite economic concerns, despite tariff and trade wars and all this stuff, they know real estate as a long-term play is a good one. So people are still buying, and consumer sentiment may be down, but the family that just had the third baby, who have kind of survived and made 1,100 square feet work, they need a bigger house, despite interest rates, despite consumer sentiment or uncertainty about the U.S. economy. They've got enough certainty in their household economy that the jobs that we hold today are jobs that are very likely to continue, and they'll continue with expected pay increases. So although it's not comfortable or ideal, we're going to step into this new home with a 7% interest rate, knowing that it's never going to get worse. The bank's not going to knock on my door and say, hey, how about 9% this year? We'd like a little bit extra interest. Never going to happen. Warren Buffett talks about how the 30-year fixed rate mortgage is the greatest tool of all time because you can negotiate it lower when rates go down, aka refinance. But with a fixed rate mortgage, it'll never go up. And some of the most magical things about a mortgage that people forget is that as everything around you increases, I was messing around yesterday looking at, average wages from 25 years ago and the average cost of anything 25 years ago. And while everything around you doubles in price, that fixed rate mortgage, that payment stays the same. So imagine if you locked into a mortgage a decade or two ago and $1,600 a month in 2005 might have felt like a lot. It might have been a bigger percentage of your income. It might have been, the equivalent of 3 months of groceries. It might have been relatively a big number. And you fast forward 2 decades, now 1,600 is like 1 month's groceries for a family. Now 1,600 is, your car payment and your insurance. It's so much smaller than it was 2 decades ago. Yet because of that 30-year fixed rate mortgage, that's still your monthly payment. You're paying that mortgage in the future with future dollars that are worth less because of inflation. Inflation will continue to make the average dollar less powerful, but you still get to pay that same number in the future. So I don't know, long-winded explanation. At the end of the day, I think I had 4 clients get into contract. We locked 4 loans last week. Buyers are going to continue to buy. Professor Scott Galloway and others are going to continue to say it, even though sometimes it will fall on deaf ears. Real estate is still a great investment. But as a home buyer, my reminder to you is it's never a timing thing as far as the market is concerned. It's always a timing thing as far as you and your family and your personal finances are concerned. So never ask the question, is it a good time to buy? Is it, smart given X, Y, and Z? It's personal to you. You look at your personal finances, your personal balance sheet, and how much money do you have saved? Do you have an emergency fund? Is your job secure? And you talk through that with somebody to realize, are you ready? Is it the right time for you personally to buy? Because if it is, then you don't have to track the home value and all that stuff month by month. Just know that you're going to have shelter and you're going to look up in 10 years and it's going to be worth 60% more. Or you're going to wake up in 20 years and you're going to have that still small fixed rate payment relative to everything else. And you're going to have a home that's worth 114% of what it was when you bought it 20 years ago. And over those 20 years, you've paid it down and now you only owe this much and it's worth this much. And you can do whatever you want from there. You can sell it and buy something new. You can refinance it and pull out some capital, send some kids to college, all kinds of stuff. So anyhow, long-winded way of saying consumer sentiment is really just a metric measured by companies that aren't specific to you and your situation. If I can help in any way, please feel free to reach out. GreatMortgageBroker.com. Fill out that form. I'll be back next week with my buddy Nash. Maybe not. It's Memorial Day. If I miss you next week, I'll see you the week after that. Thanks for watching. Hopefully this was helpful. And thunder up to my buddy Joey Garessi. They're looking good, man. We shall see. It might be your OKC Thunder coming out of the West. I'd love to see the Knicks come out of the East. That would be a fun finals matchup. So until next time, thanks, guys. Talk to you soon.